Before we understand the stock market, let's understand the stock itself. Imagine a company needs money to grow. Instead of taking a bank loan, it divides the ownership of the company into very small pieces. Each piece is called a share and collectively it is called stock. If you own at least one share of a company, you become a shareholder. That means you are a part owner. For example, if a company has 1 lakh shares and you buy 100 shares, you own 0.1% of the company. With ownership comes voting rights, profit sharing in the form of dividends, growth benefits when share prices rise. But remember, ownership also means you share the risk. Companies need money to expand their operations. They can raise funds in two ways. 1. Debt. Take a loan and pay interest. This increases the company's liability. 2. Equity. Sell the ownership, sell shares to the public. This is called equity financing. Equity is preferred because there is no need to repay, no interest burden, risk is shared, and helps the company expand faster. And this is where the stock market starts playing a role. A stock market is a platform where buyers and sellers come together to trade shares. Think of it like a supermarket, but instead of vegetables or groceries, shares are being traded. In India, the two major stock exchanges are NSE, National Stock Exchange, and BSE, Bombay Stock Exchange. These exchanges ensure transparency, liquidity, fair price discovery, fast execution, and safety. But remember, you never go to the exchange directly. You go through a broker. This stores your shares in digital form. Earlier shares were paper certificates. Today everything is digital, stored with NSDL or CDSL. Popular brokers include Zerodha, Upstocks, Angel One, Grow, ICICI Direct, and many others. Just like you need a bank account for money, you need a Demat account for shares. When a company first sells shares to the public, it is called an IPO, Initial Public Offering. This is where companies raise money from investors for the very first time. Secondary market. After IPO, the company's shares get listed on the exchange. From this point on, people buy and sell shares among themselves. The company does not get this money. Most of the trading you see daily happens in the secondary market. This is a very common question. Why does the price of a stock go up or down? The answer is simple: demand and supply. If more people want to buy a stock, price goes up. If more people want to sell, price goes down. But demand and supply change because of many factors. 1. Company performance. Better profits, more buyers, price rises. Poor profits, more sellers, price falls. 2. News and announcements. New partnerships, product launches, acquisitions, leadership changes, everything affects sentiment. 3. Economic environment. Interest rates, inflation, GDP growth all impact market behavior. 4. Industry trends. If electric vehicles become popular, EV stocks rise. If IT spending slows down, IT stocks may fall. 5. Global markets. US markets, oil prices, geopolitics all impact investor behavior. Prices never move randomly. They move due to expectations and reactions. There are different types of people who trade or invest. 1. Retail investors. People like you and me. FIIs, FPIs, foreign investors. They invest huge amounts of money. They have a major impact on Indian markets. DIIs, domestic institutional investors. Mutual funds, insurance companies, pension funds. Traders, they try to earn quick profits by buying and selling frequently. Investors, they stay invested for years and build wealth. Understanding who is buying or selling gives you clues about the market trends. You can earn in two ways. 1. Capital appreciation, when the stock price rises. For example, you buy at Rs 100, sell at Rs 150. That means 50 rupees profit per share. 2. Dividends. Companies share a portion of their profits with shareholders. Dividends are passive income you earn without selling your shares. Inflation reduces the value of your money. If your money sits idle in a savings account, it loses purchasing power over time. Stock investing helps you beat inflation, build long-term wealth, and achieve financial goals.
participate in India's economic growth, retire comfortably, and create financial freedom. Historically, over long periods, the stock market has given better returns than FDs, real estate, or gold. Many beginners fear the stock market because of myths. Myth 1. Stock market is gambling. Reality, gambling is guessing. Stock investing is based on research, fundamentals, and long-term thinking. Myth 2. You need a lot of money. Reality, you can start with even rupees 100. Myth 3. Only experts can invest. Reality, anyone can learn with the right education. Myth 4. Stocks always fall. Reality, markets rise and fall, but long-term trend is upward. Let's avoid these from day one. Buying stocks based on tips is a big no. Expecting overnight profits is also a big no. Not diversifying is a mistake. Panic selling in downturns. No clear strategy. Checking prices every minute is also not good. Investing money needed immediately. Ignoring risk management. Successful investors follow discipline, patience, and knowledge. Today we covered what is a stock, why companies issue shares, what are stock exchanges, what are Demat and trading accounts, primary versus secondary market, why prices move, market participants, how you earn, risks and mistakes. This is the foundation. In the next lecture, we will go deeper into types of orders, market cap, index like Nifty and Sensex, bull and bear markets, basics of risk management. If you want lecture 2, just tell me, I'll prepare the full script. Thank you for watching, and remember, stock market is not complicated. You just need the right start.